Hello and welcome to this session in which I would work an example reviewing the accounting method for tax purposes, whether you are using cash method or accrual method for both income and expenses. Now this topic, I do have it covered in details, in detailed explanation. In this session, first I will briefly go over the rules for revenues for income and expenses, then I will work an example illustrating those rules. But before I start, I would like to let you know that if you are studying for your CPA exam or if you are taking an accounting course, I strongly suggest you check out my website, FArhatLectures.com, whether you're a CPA or an accounting student. But especially if you are a CPA candidate, I do have additional resources, lectures, exercises, true, false, multiple choice that's going to help you prepare for your exam. No, I don't replace your CPA prep course. I don't replace your Becker. I don't replace your Roger. I don't replace your Y-League Lime or any other course you are taking. I am just an addition. I can be an addition and a useful addition to improve your grade by 10 to 15 points. How do I help you? I help you understand the material better. I go over the details more than a traditional CPA review course. Review course means they're reviewing it with you. You already know it. I don't assume that you know it. I assume that you know nothing and I will start from scratch. And here's my offer to you. Will you be able to invest $29.99, my subscription, to try out this? If it works, if you feel it, you can have access to a month. If you feel it's helping you, I would suggest you keep it. If it doesn't, you lost $30. Are you willing to risk that for improving your CPA score? So the loss is limited, the gain is unlimited. Think about it. I also have various accounting courses, and please connect with me on LinkedIn if you haven't done so. And on my LinkedIn, check out my LinkedIn recommendation to see how other CPA candidates use my resources. Please like this recording and share it. Connect with me on Facebook and Instagram. So we're going to be looking at the cash method versus the accrual method when it comes to taxation. Now, what's the overall idea for the IRS? Remember, the IRS, the idea of the IRS, they want their money as soon as possible because that's their job. Their job is to raise money for Uncle Sam. Basically, the IRS, it's like the debt and the equity of the government. This is how the government raise money. It's actually the revenue, the government's revenue. So they want their money as soon as they can. So when it comes to revenue recognition, if you actually receive the money or you constructively receive it. Actually receive it means you have it in your hand, you have it. Constructively receive it means it's available to you with no restriction. Although you don't want to cash the check or you don't want to deposit the check, you keep the check in the mail. Nevertheless, you have access to it. You constructively have access to it. Now, also, if somebody transferred the money to your account, well, guess what? You don't have the cash, but the money is in your account. It's credited to your account. You're aware of it. Then you constructively received it. For the income recognition for cash, simple. You have it or you constructively have it. It's revenue. Under the accrual method, taxable once all events test is satisfied or the income is recognized in the financial statements. So first, let's start with the easy one. Income is recognized in the financial statements. So if you are using accrual for tax purposes, that's fine. You can use accrual. Actually, certain companies that if your revenue for the past 3 years on average is 5 million or above your sales, then you have to use accrual method for tax purposes. That's fine. But here's what they say. If you're using the accrual method and you happen to recognize your revenue for on the financial statements, then guess what? It becomes automatically recognizable for tax purposes. Simply put, what's the idea behind this? The idea is, for financial accounting, you want to recognize your revenue as soon as possible. That's fine. You want to show the good news, that's fine. But if you're going to show the good news for your investors and creditors, it becomes automatically taxable. Okay? Or if you did not show it on the financial statement yet, it's taxable once all event test is satisfied. Now, what is this all event test? It's basically a two-test type of test. Okay. First, you have to know the amount. You have to reasonably determine the amount of the revenue or estimate. Estimate is good. So first you have to know the dollar amount. So this is kind of known. This is the first test. And the second test is you are entitled to the income. What is entitled? It means you have the right. You are entitled to the income. You are entitled to the income. Okay, so you know the amount is fixable or determinable, or you can estimate it, so we're good with that, and you are entitled to the amount. When are you entitled to the revenue? Just let's think about it. Well, you could be entitled to the revenue under 3 circumstances. If you bill the client. If you bill the client, look, you don't bill someone if you did not earn it. So think about it. If you earn it, that's it. You are entitled to it. Or if we can see that you bill them, then you are entitled to it. If you bill someone, if you told someone you have to pay me, well, then guess what? Then you are entitled to the money, right? And the third option is if they paid you. If they paid you the money, then you know the amount, you're entitled to it. You got the money. Hold on a second. Are you saying because they pay me, now I have to, it's taxable? Yes, you are entitled to the money. You have the money in your pocket. And what does the IRS wants to do? You have the money. As far as we're concerned, you have the ability to pay your taxes, pay your taxes. So if they pay you, guess what? You know, it's revenue as far as the IRS is concerned. Okay? So this is what we mean by the all event test. You know the amount, you are entitled to the income. How do you know whichever comes first, whether A, B, or C? If you bill them, now you're entitled to the revenue. You did the work, you're entitled to the revenue, or you got the money, you're entitled to the revenue. This is what all event tests imply. So basically, they want their money as soon as they can. And if you recognize it on the financial statements, yes, now you're going to have to pay taxes on it. So that's for income. That's the general rule. What about unearned rent and interest income? What is unearned? It's when someone pays you up front, right? You have unearned revenue. The cash method, easy. You have the money because unearned revenue implies they paid you. It's taxable. Guess what? Accrued, taxable as well. Again, the same idea that I explained earlier, that if you receive the money is in your pocket, somebody paid you 1 year worth of rent up front, you are renting a commercial property. Basically, from a financial accounting perspective, that's unearned revenue if you're using accrual. For tax purposes, you have the money. You have the money, we're going to tax you. Let's take a look at this one. Advance payment for goods and services. So somebody pay you for advance payment for goods and services. Cash is easy. I have the money. If they paid you in advance, you have a taxable income. Now notice here, I just want to make sure, unearned rent and interest revenue, they are unearned. Just similar to the advance, the same concept. Somebody pay you up front. But if someone pays you up front for goods and services, so notice I have to point out the difference. Here we're talking about rent and interest. That's different. It's always taxable immediately. When it comes to advanced payment for goods and services, we have a little wiggle room that you'll be able to kind of defer it a little bit. Okay? So taxed when received, or, notice, or, so generally if you want to pay the taxes, by all means, the IRS will not say no, or the taxpayer can elect to be taxed in the year following the receipt, if not earned by the end of the year of receipt. So now I'm in year 20, we're in November 2020. Yes, that's the year that everybody wants to be in, right? Okay, and I received money, advanced payment for goods and services. Let's assume I received this money, but I'm not going to perform the service until this period in 2021. Because that's the case, I can defer it until the end, until next year. So I do have a small wiggle room. Remember, it's for goods and services, not for rent and interest. So keep that in mind. The IRS, they're very particular about this. Okay, now let's talk about deductions. What's the general rule for deduction? When do you recognize deduction? Under cash, well, deduct when paid. That's basically what it is. You deduct when you pay it. So economic performance does not apply. Whether you incur the expense, you did not incur the expense, it doesn't matter. You deduct when we pay it. Now, bear in mind, not everything. For example, for inventory, there are certain rules for inventory. Obviously, if you buy property, plant, and equipment, and we're going to look at different rules. But this is the general rule: is you deduct it when you pay it. Again, with few exceptions. Okay. For accrual method, deduct once all events test. Remember the all event test for revenue? Simply put, you have an all event test as well. And what is the all event test? It's basically the cost did incur. So you have to wait until the cost did incur. Okay? And economic performance tests are both satisfied. So the cost incurred and you have an obligation to pay. You have an obligation to pay. So this is basically, but there are some exceptions here. I'm going to start with the first exception. There are certain expenses, okay, that you can pay for them, although they may not be economic performance occur. So the cost did not incur yet. So you paid someone to do something for you, incurred an expense, but they did not do it yet. As long as you reasonably believe they're going to complete it within 3.5 months. So 3.5 months, a quarter and a half, okay? Quarter and a half of a month, 3.5 months, then you can deduct, okay? So notice it wasn't incurred yet, but you can deduct it, okay? Once again, the idea of expenses is the IRS wants you to defer your expenses. Because if you recognize you as the taxpayer, you want to recognize your expenses now. It's basically the opposite of everything that you learned in financial accounting. In financial accounting, you want to recognize the revenue because you're going to look good, you're going to look profitable, and you want to delay the expenses because expenses will take away from your profit. The tax is opposite. The tax, you're trying to defer the revenue and accelerate the expenses. Okay? Now, what happened if you incur expenditure for tangible asset with a useful life more than a year? What are we talking about here? We're talking about property, plant, and equipment, tangible asset. Well, for cash method, you have to capitalize and apply the cost recovery, which is, we have a whole chapter about the cost recovery, aka depreciation, right? For accrual, same thing. Capitalize and do the cost recovery. I have a whole, 6, 7, 8 lectures about this. Expenditure for intangible assets other than prepaid. We're going to deal with the prepaid separately. So those are expenditure. Intangible asset, same thing. Other than the prepaid, same thing. You capitalize them and you amortize them. Okay, that's all what you have to do. For accrual, same thing. You capitalize them and you amortize them. Again, expenditure for more than a year. Again, they don't want you to take all the expenses up front. Now, you would love to take all the expenses. Now, they do have, bonus depreciation. We'll learn about this later on. But the general rule is you capitalize the asset, then you either take the depreciation, or if it's intangible asset, the amortization. Let's talk about prepaid business expenses. Like when you prepay your insurance, you can prepay your rent, so on and so forth. For cash method, listen, immediately deductible. However, there's a rule with like a kind of two rules all at the same time about prepaid. One, amortize if the contract exceeds 12-month period. So the first thing is, if the contract, whatever you prepaid for, rent, insurance, whatever you prepaid for, extend, if the contract is more than 12 months, forget about it, you cannot expense immediately. Or the contract extends beyond the end of the next taxable year. So you have to be careful. What does that mean? Again, let's look at an example. This is year 2020. We are in November the 18th, not the 16th. I thought I said earlier the 16th. It's November the 18th. This is 20, this is 2021, and this is 2022. Let's assume I sign a 1-year contract, or 11 months to be more specific. It's not exceeding 1 year. But I signed it today. I paid for it today, but it takes effect. It covers me from this period to this period. Let's assume this is from September 2021 till August 2022. Guess what? I can no longer expense it. Why? Because it's going into 1, 2, 3 years. This contract is extending over 3 years. Forget about expensing. So they do allow you to expense it as long as it's less than a year, the contract is less than 12 months, and that 12 month, it doesn't extend into that 3rd year, into pass beyond the next taxable year. It means it goes into the 3rd year. Okay. Same with cash method for accrual. Otherwise, apply all event and economic performance tests to ascertain when they capitalize and amortize. Simply put, follow the same method as for the prepaid. Again, they would allow you, there is a small wiggle room. Otherwise, apply the all event and economic test. When, if you're paying for the expense, when is that expense taking place? Okay, you just have to spread it out, spread the expense, spread the prepaid. Let's talk about prepaid interest expense. This is easy because the rule is clear. You cannot prepay your interest expense. Actually, you can. That's no, the bank will take your money, but it's not deductible until interest is accrued. It means time went by. This is for cash. So simply put, you cannot prepay your expense. For accrual, same thing. If you want to prepay your interest expense, your lender would love it. They will take your money, but you're not going to get a tax benefit until the time passes by. Same thing. So be careful about this, because this is basically an easy exception to deal with. Okay? Let's talk about bad debt expense. Well, let's think about it. If you're using the cash method, well, do you have any bad debt expense? And the answer is no. When do you have a bad debt expense? Is when you recognize revenue on credit. Well, you don't have this. You don't have this problem. Not deductible because sales on account are not included in income. So you don't have any sales on account to be able to deduct bad debt expense. Under the accrual, well, here we go. You have to use the direct write-off method. And this is awesome, because every time I teach the direct write-off method under my financial accounting, I would say it's used for tax purposes and kind of discounted, like it's not a big deal. Well, this is a big deal in tax. Bad debt expense is deductible under the direct write-off method. What's the direct write-off method? It means you as the taxpayer determine that this account is no longer collectible, and you'll have certain policy. For example, you'd say after 9 months or after a year, you have to have a policy. They'd say, you know what, after 10 mailing, that we warned the customer, they did not pay, write it off. So we have special rule, and so this way we don't estimate the expense. Once we decide to deduct it, we will deduct the expense. Now, the best way to illustrate all these rules is to work a short example. But once again, I have maybe a 40-minute lecture about all these topics a little bit more in details. I know I went a little bit more in details than I wanted to. I didn't want to shortchange you, but let's look at an example. Rebecca is a calendar year taxpayer who operates a business. She made the following business expenditure. So we're looking at expenditure in December this year. Indicate the amount of these payment that she may deduct this year under both the cash and the accrual, cash and accrual. So let's go ahead, cash and accrual. Starting with the first A. A is Rebecca paid $2,000 to an accountant to evaluate the accounting system of Rebecca's business. The accountant spent 3 weeks in January of the next year working on the evaluation. Let's start with cash. Easy. I paid $2,000. I can deduct $2,000. Accrual. What should I do here? Well, this is basically a general business deduction. I paid for, this is consultancy, or I'm not sure what you want to call it. I would say consultancy more likely. Okay? So what do we have to do? If it's accrual, the work happened in January, so we should not deduct it. However, remember this rule here. We have that 3.5 month wiggle period. As long as the work done within 3.5 months, and you have to believe it's gonna be done. And here it was done during the three weeks in January. Therefore, we can deduct it, and we should deduct it in December, right? We want to take the expense as soon as we can, using that wiggle room of 3 months. That's A. Let's look at B. $2,500 for a new office furniture. So what does it say here? We paid. The furniture was delivered on January 15 of next year. Well, for cash purposes, 0. Yes, we paid in December. That's what it says, right? We made those expenditure in December. We did not have the office furniture. That's one thing. 2, remember, the office furniture is a tangible asset. Therefore, we cannot deduct anything for cash purposes. Okay? As far as cash purposes, this is a tangible asset. We're going to have to depreciate over its life, whatever class life. I believe it's at 5 years, office furniture. I think it's 5 years. Okay? Because it's providing benefit more than 12 months, and obviously under the accrual, basically the same thing. Remember, the rules are the same when it comes to more than a year tangible property, that's what it is, property, plant, and equipment. Okay? $3,000 for property taxes payable on the factory. So Rebecca, she paid $3,000. Well, did she pay the money? Yes. So for tax purposes, under cash, it's taxable. Well, property taxes. Okay, so property taxes is basically a general deduction. Basically, it's part of operating the business. You have to pay to operate in that area. Therefore, the expense actually incurred. In other words, there is an economic performance because the state or the county or the locality, they're not kicking you out, right? So you are paying your property. That's fine. So you can deduct up to $3,000. Just also, you can also prorate this payment. So if this payment covering a different period, you can prorate it. Okay, there's a small rule here, but under accrual you can also deduct this $3,000. But know that for property taxes, because sometimes property taxes, they have different tax year than your tax year, so you could move some expenses out if you choose to. And why would you do that? Well, for tax planning. For example, this year you have plenty of expenses. You don't want to take any more expenses, so you defer the expense. But again, that's beyond the scope of what we are doing here. D, $1,500 for interest. You paid $1,500 on interest on a short-term bank loan relating to the period from November 1st of this year through March 31st. Okay, so we paid this, that's fine. If we paid $1,500, that's excellent. Okay, that's fine. We wrote the check. However, this check covers November, December, January, February, and March, right? Yes. So if we paid $1,500, this $1,500 is covering 1, 2, 3, 4, 5 periods. What we have to do is we have to divide it by 5, and for every month, 300. And the only period we can count that we can deduct for cash purposes and for accrual is November and December. So this is $600 here and $600 here. Yes, we did prepay for those 3 months, but too bad we cannot expense them. Remember, prepaid interest is something you need to be aware of. Just know it. That's what they ask you on the CPA exam, therefore it's easy exception to remember. Once again, at the end of this session, I'm going to remind you, if you are a CPA candidate, my offer to you is this. Try my method. It's going to cost you $30 to try it out. If it's helpful, good, you made a good investment. If it's not, you lost $30. Are you willing, though, to pay $30 to test, to find out if I can help you on the CPA exam? And by doing so, I can increase your grade. And it doesn't matter which course you are taking. Practically, my material works with any CPA course. It's a vitamin. It's like a vitamin pill to your CPA course. And if not for anything, visit my website to figure out how well your university is doing on the CPA exam. Study hard, good luck, and of course, stay safe.